Good afternoon, everyone, and thanks for joining us for today's webinar, Construction Accounting and Industry Update. I'm Dan Sturm, Partner and Construction Practice Leader with McKonly Asbury. For those of you who don't know, McKonly Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, and Bloomsburg, Pennsylvania. We provide a range of services to organizations across a variety of industries and have a dedicated team of professionals to serve the construction industry's accounting needs. We encourage you to visit our website to learn more. If you've joined us on past webinars, welcome back. If you haven't, our monthly webinar series features various business topics to keep you updated on what's going on around us. With COVID, we added to our monthly lineup to bring you additional content on the ever-changing regulations, including the Paycheck Protection Program and Employee Retention Tax Credit. So be sure to check out our website to catch past presentations as well as current information through our blog. Before we get started, I want to mention if you have any questions for us during the presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during or after the webinar. Also, for those of you who are looking to obtain CPE credit for today's webinar, please keep in mind that there will be 4 polling questions throughout today's presentation, and you'll need to answer all 4 of these to get your certificate via email a few weeks after the webinar. With that, let me take a minute to introduce you to today's speakers. I have with me Aaron Stagliano, Senior Manager in our Bloomsburg office, as well as Tim Showers and Zachery Starner, Managers in our Camp Hill office. Later on in the presentation, you'll also hear from Gary Rispoli, Partner and Director of Surety at Construction Risk Partners. Gary has joined us during last year's webinar, and we're excited to have him back with us again this year. With that, I'm going to turn the presentation over to Tim Showers to talk about some lessons learned from the implementation of ASC 606.
Thanks, Dan, and thank you everyone for joining us this afternoon. One topic that we definitely wanted to cover during our time today was just to take a couple minutes and take a step back and take a look at some lessons learned from implementation of the new revenue standard. So most companies have been through it twice at this point in terms of year-end close under this new standard. And so taking a look back at that, there are certainly some things that we were just able to look at once in terms of initial implementation and be good with pretty much for good going forward. However, there's a few things that have definitely stuck out to us that are going to be with us as a key recurring considerations from year to year. So really a key takeaway that's really jumped out to us here is that you really want to develop a month-end or at least a year-end process to review for significant instances of these 3 key items. So just going to take a couple minutes here to talk about each one of these. And so one item that definitely has we've come across as something that could change from year to year and certainly be relevant in a lot of contracts is this topic of variable consideration. So for variable consideration, we're talking about those things that aren't necessarily set in stone as you go about completing the project. So some examples of this would be incentive bonuses, liquidated damages, early pay discounts, pending change orders, or cost savings arrangements. So one of the key things to do is really have a process in place to identify these portions of your contracts, and really identifying them is going to be half the battle, because once you have a process in place to identify them, the accounting, then you can think it through the accounting from there. So each one of these 3 items that you see listed there has its own unique challenges. So probably for variable consideration, the easier part when it comes to this is identifying them in the first place, because these will be the most evident from the standpoint of the accounting team, because the contracts and the invoices that are going to be coming through and passing through your team, you'll be able to spot these based on the documents alone in most cases. The hard part when it comes to these is actually going to be the accounting piece, just because it involves a lot of significant judgment in terms of how to account for these as you go along. So when you're thinking through something, how to account for like a pending change order or early pay discount, just a couple reminders under the guidance and how the guidance would lead the thought process for that. Some things to consider would be what amount is probable of collection when it's all said and done. What do we expect to collect when it comes to that variable consideration when the contract is complete? And whatever you deem to be probable is what the guidance would have you book or use as your projected revenue as the basis for your accounting as you go along. So some things to think about in terms of determining probable collectability. Think about your relationship and familiarity with the client on that project. What type of history have you had with them? Are they, if you have a pending change order with them, are they the type that will follow through and execute that change order for you based on past history? Also, when you're thinking about things like potential bonuses or liquidated damages, think about your company's past history with similar projects, because that can really inform your decision in terms of determining a most likely outcome. So there's a lot of judgment, a lot of room for judgment under the standard here, but those are just some things to think about as you go along. And the key here in terms of implementation and applying this from year to year is just make sure you have a good process in place that you're comfortable with and that you're consistently applying across similar contracts and similar periods from year to year.
Hey, Tim, this is something you and I have talked a lot about with several of our clients. And I think you mentioned at the beginning a month in, or at least an annual process. I think an annual process for most of our clients is probably sufficient when looking at variable consideration, because the job starts and finishes all in the same year. It's not a whole lot of risk with this. It's really those jobs that are open at year end and assessing, do we have any variable comp that we need to adjust some prices for and things like that. So I think that minimum of the annual process probably serves a lot with this. And one thing that Tim and I have talked a lot about as we've gotten through some audits and things like that is this highlights this kind of one of the things that stood out to us. The standard offers a lot of subjectivity. So it's not always, okay, if this, then that. It does provide a ton of judgment, and this variable consideration component is a key piece of that. And so I think what we saw was maybe some policies that would indicate, okay, we're always going to do it this way. As we got through the second year of 606, that's not always the case. So every contract seems to have something a little bit unique about it. So I'd make sure accounting policies are set up in a way that it's not so pure black and white, that it allows for you to have some conversation at year end to talk about, okay, 9 out of 10 times it's always going to be this, but maybe that 10 out of 10, maybe that 10th time it's going to be something a little bit different. So I'd make sure your policies, your accounting policies, are a little bit adaptive to that process.
Yeah, absolutely, Dan. Good observations there. And I would agree that an annual process in most cases will be sufficient, not only for the variable consideration review, but also for these other two listed there that we want to talk about, those being uninstalled materials and costs of waste and rework. So for both of these cases, these items won't necessarily be as evident just to the accounting team alone based on what's coming across your desk and what's flowing through your team as you account for the projects. So this is, for these two other instances in particular, we would definitely recommend that shortly after year end or near year end, you're getting your accounting team and the project manager team together to talk through the projects, because these particular instances, you're going to want that firsthand knowledge of those that are at the job site regularly, because they're the ones that you're going to be able to just have that awareness of any instances of these. So for uninstalled materials, the reason this is a key item to keep in mind at year end is because when it comes to these items that you've procured for the job and you have them sitting at the job and they just haven't been installed yet, in terms of the project that you're working on. Depending on the nature of the materials, they might not necessarily be recorded like a regular job cost. So they could fall in one of three categories under the guidance, depending on the nature of the materials. So based on your review of those, you could either find that they would be most appropriate to be treated like inventory, or perhaps recognizing revenue to the extent of the cost incurred for the materials, or perhaps like a regular job cost, like the other costs that you have that you're incurring along the way. But the key, half the battle is identifying them in the first place, and then you can work through those. That last piece here, the costs of waste and rework, probably the most straightforward of the three here in terms of accounting, but the key is just identifying them. And the key piece, key reminder here would be any costs that you incur related to waste and rework. Under the guidance, these would not be considered to be reflective of progress on the job. So if you identify any significant instances of these, the key piece here would just be to remove them from your percentage of completion calculation. So in terms of these three items, again, a key takeaway, just make sure you're meeting at year end between accounting and project management. And then also we would recommend that you're raising awareness along the way. Just getting the word out to your project managers just to keep these types of things on their radar, just with the idea being that for accounting's purposes, that these particular items could trigger some different or unique accounting treatment depending on their nature.
Yeah, and I'd probably also say it's not an all-inclusive list, as Tim and I talked and kind of caught up. I'll say towards the end of this post quote unquote tax season, these are just three items that we felt, along with the rest of our team, there was some things you could observe in year two. So year one, it's I'll call it a little overwhelming, just trying to adopt the whole standard, look at the 5 steps, look at our performance obligations, get through all the key components of ASC 606. And as we sat back in year two, having all those basics behind us, these were a couple of the areas that we felt were coming up more often. We were having more discussions about those, which is why they ended up here as kind of lessons learned. It wasn't the only lessons learned, but these are probably three of the big ones we identified.
Yep, absolutely. Well, speaking of new standards, I believe, Zach, you have another one that's on the horizon to tell us about.
Yeah, thank you, Tim. As many of you are aware, we have a new leasing standard upon the horizon. The standard first came out in February 2016 with Accounting Standard Update 2016-02. The big change here is operating leases that are greater than 12 months will now trigger recognition of the underlying assets and liabilities. So what's that mean for the companies? Well, for most companies that are leasees, this means you'll now be pulling these leases, these lease liabilities onto your balance sheet. So when does the standard become effective? It becomes effective for non-public companies following a calendar year, 1/1/2022. So it's still out there a little ways, but it'll be here before we know it. For anyone interested in learning more about the new leasing standard, we actually have a webinar May 27th, so feel free to tune in for that.
No, thanks, Zach, for that. I think one thing I would just make note of, probably well in advance of May 27th, is if you haven't started down this road and looking at your leases, if you have any kind of sense that you have more than a handful of leases, I would definitely get in front of that sooner rather than later. I'd also say if you plan to use Excel for accounting for your leases and you have, I'll just throw out a number, maybe more than 10 leases, definitely probably want to think through that. I've already had at least one client call me this week alone saying they started down the path of Excel and there's just too many end-if scenarios, a little too cumbersome to try to navigate through Excel. So looking for some alternatives on how that could be done. And we do, I won't get into it here, it'll be more on our lease webinar, but There's a product out called Simplease. It's developed by an accounting firm in our network. So seen a lot of good things we like about the product. It's developed by accountants. So for those of you going through audits and having to draft financial statements, it comes with the accountant in mind. It's not necessarily from a technology perspective. So a lot of good information, creates your disclosures for you, tracks your leases for you. And we'll have a short demonstration during that May 27th webinar. But definitely consider, if you have more than a handful of leases, getting in front of that process if you haven't done so already.
Thank you, Dan. Next, I'd like to transition to our first polling question. What is the most significant challenge facing your business today? A, insufficient backlog, not enough work. B, not enough skilled labor to get the work done. C, overall unpredictability of the next 6 to 9 months. D, outdated technology. Or E, other.
Yeah, and I'll be honest, Zach, each of those you listed, I think I've heard them all. I think there's a couple I hear more than others, and I'll be curious what the poll results show. But I've definitely heard each of these, and I wouldn't say scattered over the past couple of years, probably within the past few months is all conversations I've had.
Yeah, I'll be curious to see the results. But one of the trends that I've been seeing across my construction clients is certainly point B, not enough skilled labor.
Yeah, and Gary, not to put you on the spot, I know you work in, so you see a lot of different markets. I'm curious if you see a mix of all these as well.
I do, and it varies a little bit by marketplace and by even market sector in terms of what kind of work a contractor does. So it runs the gamut for sure.
All right, looks like our results are in. Yeah, overall unpredictability in the next 6 to 9 months doesn't surprise me at all. I think I probably would have expected the labor to be number one, but not a shock at all to see unpredictability over the next 6 to 9 months. I think every industry across the board is kind of wondering what's next, trying to follow the news cycle and everything changing. So I appreciate those that responded. And I think with that, we are heading back to Zach with some PPP loan accounting.
Yep, thanks, Dan. So PPP loan accounting, companies basically have 3 options available to them in how they record the PPP loan. Those options would be the debt model, the government grant model, and the International Accounting Standards 20 model, accounting for government grants. So the debt model, we'll discuss the debt model first. This is the AICPA safe harbor model and the preferred accounting method for-profit companies. The debt model delays recognition of the gain for forgiveness until the debtor has been legally released as the primary obligor. What does this mean in terms of, for your company? I think where this comes into play, it'll be receiving that SBA forgiveness letter. When companies receive their SBA forgiveness letter, at that point in time, they've been legally released from that obligation to repay the loan, and we would transition it to other income at that point in time. Up next, we have the government grant model. Obviously, this would be the preferred model for nonprofit organizations, but can be applied to for-profit companies as well. The initial amount will be recorded as a refundable advance or a current liability, and the company records grant income at the point they substantially meet the criteria for proper use of the funds. And lastly is the International Accounting Standard model. This would be the most aggressive model and would open potentially the company up to the most risk or potential scrutiny by maybe the board of directors, banks, or the company's auditors. For-profit entities, but management must elect to follow the international accounting standards. In my time through This past tax season, I've only seen one company adopt the International Accounting Standards model. I would say I see a lot of the debt model being the popular option for my clients.
Yeah, I would echo that, Zach. I think most of what I've seen is the debt model, and I think more so just because companies feel better knowing they have that SBA approval in hand, so they're not looking at a situation at some point in time where they have to reverse that income. I don't know how big the risk is, but I feel like of our clients and those that I've talked to have applied the debt model. I think just this week I did see this government grant model as well. So it's a mix. So if you're talking about consistency across the board with accounting, it's definitely not the case with PPP loan accounting. We're definitely seeing it all. It depends on the client situation. It depends on where the client wants to be. Some clients don't even want to just carry that debt on their balance sheet. So if there's an opportunity to clear that debt off, bring it into income for 12/31/2020, they've done so. And quite honestly, all are acceptable under the model. But we're definitely seeing a mixed bag.
Absolutely. Thank you, Dan. Up next, we'll transition to Aaron for R&D tax credits.
Thank you, Zach. I'm going to talk about a few tax credits that are potentially unique to the construction industry, but very well may be applicable to your company. We're going to start on the very first one that's on our slide here. Is called the Research and Development Tax Credit. And if I have any advice, it's don't automatically assume that this credit does not apply to your company in the construction industry. Companies that this credit is designed for companies that design, engineer, or construct more or less something that hasn't been previously done, or you're doing something in a new fashion, such that those expenses that you've incurred may qualify as research and development expenses under the IRS guidance. It's a dollar for dollar savings that reduces your tax liability. So it's a potentially lucrative credit if you're spending a lot of resources doing R&D type activities. And even if you've been doing these activities for the past couple of years, but you haven't claimed the credit, there's an opportunity to go back and amend at least the last 3 years tax returns to reclaim these credits and get a potential refund. The credit is available at both the federal and potentially the state level. So same concept. If you've got federal credits, you can look at it and see if we can apply state rules to these activities and see if there's potential state credits. And generally for federal purposes, it is 6 to 12% of those eligible expenses. And you're probably saying, well, what qualifies as eligible R&D credits? And we've put some on the next slide that more or less deal directly with the construction industry. Potential examples here again: developing and improving construction equipment, designing new methods to meet the requirement of a project, designing HVAC systems and electrical systems, using building information modeling, preparing a structure and facility design for constructability, meeting building codes for new ways or for the first time doing it a different way. And a big one here, certainly over the last couple of years, green building technologies is very large in the commercial construction space. Great opportunities for R&D credits doing that. But by and large, overall, if there's anything that you're doing that's potentially groundbreaking, new in the industry, innovative, it's worth asking the question, hey, are any of these expenses applicable to R&D activities?
Yeah, and Aaron, I can't emphasize enough that first point. Don't assume it doesn't apply. A lot of companies, first time hearing us talk about this research and development, they're like, oh, I'm not doing any of that. Don't assume. If any of these points you think might apply, we've seen many clients get some pretty healthy checks back in the mail, especially when you can go back 3 years on an ongoing basis. This money adds up. So it's definitely don't assume, and take some notes. If you think you might apply, reach out to us, and we'll help navigate you through that process.
Thank you. And with that, I think we're going to go, employee retention tax credit. That's up number 2, the employee retention tax credit. You've probably heard about it, read about it in the newspaper or online. I guess it's been a hot topic certainly amongst the business community. A little background: in 2020, if you took a PPP loan, the IRS basically said that's your government benefit. You're not going to be eligible to take the employee retention tax credit. Here in December, when the stimulus bill was passed, in late December, the IRS reissued guidance that said, okay, even if you took a PPP loan, you can also take the employee retention tax credit back into 2020. So that opened up a great opportunity for many clients to go back and claim the employee retention credit for 2020. And then we'll talk, they even expanded it here into 2021. But a little background on the credit. Basically, it's designed to, they want businesses to keep their employees on payroll, similar to the PPP loans. The credit is potentially equal to $5,000 per employee per year for 2020 if you qualify, and then in 2021, if you qualify, it's up to $28,000 per employee per year. Again, it's applicable even if you got a PPP loan, and it is claimed on the quarterly 941. So it's actually a reduction of required payroll tax deposits that you have to make. And if you say, well, I already filed all my 941s for 2020, again, if you qualify for this retention credit, you can go back and amend your 941s that you filed here during 2020 and get a refund of those credits that you could have certainly applied for had you known at the time. And the good thing about this is the deadline, to our knowledge, is going to be the 3-year statute of limitations. So you're actually going to have about 3 years to go back and amend your 2020 941s to reclaim these credits. So how are you eligible? For 2020, if you had a reduction in gross receipts during any one quarter of 2020 compared to the same quarter of 2019, and you had 100 or fewer employees, you're eligible for that credit for any quarter for which your gross receipts were 50% less than they were in 2019. So if you took a big haircut revenue-wise in 2020 to the tune of 50%, you'd be eligible. Or, and this is a big or, if your business operations were wholly or partially suspended due to government mandate at any point during the calendar quarter, that entire calendar quarter would apply. And potentially the payroll that you've paid during that quarter can be used to claim the employee retention credit. So for most of the construction industry in Pennsylvania, we were shut down March 15th all the way through May 1st. So certainly there's opportunity in both Q1 of 2020 and Q2 of 2020 for this credit to apply for the construction industry clients. In 2021, they expanded the eligibility. If your gross receipts in 2021 were 80% or less of that same quarter in 2019, you would qualify, and you can have it if you have 500 or fewer employees. So for 2021, you know, if you're back up to a decent amount of revenue in 2021, but you're not quite where you were in 2019, and you have less than 500 employees, it's worth looking into the employee retention tax credit. And we've got a great team that's certainly helping many of our clients trying to determine whether or not they are eligible for this credit.
I agree, Aaron. There's a great opportunity out there, especially if you meet any of those criteria you described. Definitely try to take advantage, reach out if you have questions, comments on how to apply that credit.
Okay, next slide, tax planning strategies. Again, there's a couple of different strategies that we can incorporate for construction contractors. One's going to be the basis of accounting. this isn't something you can change every year, but by and large, how do you report income and expenses on your federal income tax return? There's three main options for construction contractors: cash basis. I claim income when I get paid. I claim expenses when I pay my bills. It's pretty straightforward. It's most advantageous if you want to accelerate or decelerate income and expenses. Cash basis is great. There are some limitations to it. By and large, most companies report on the percentage of completion. This income for tax purposes is recognized as revenue is earned. This is required to be used by most construction contractors that have more than 25 million in annual revenues. And the third option, completed contract. Basically, I defer all of my income and expenses on large contracts until the contract is complete. And at that point, my net profit on that contract gets recognized for tax purposes. Good opportunity here for small contractors to defer profit to a future year. But if you don't watch your cash flow, there's potentially some issues that could come out of the completed contract method. Some other credits that are available specifically to construction contractors: fuel tax credits. If you're buying a sizable amount of fuel for off-highway use, there's a federal tax credit that you can claim and get a little bit of a refund of your excise taxes. So if you have a lot of off-road diesel in generators, heavy equipment, machinery and equipment that doesn't go on the highway, there's a potential credit for that. It has to be accounted for separately. And work opportunity credits. Credits available for hiring eligible employees from targeted groups. Certain veterans, ex-felons, long-term unemployed may become very relevant SNAP recipients, SSI recipients. So another opportunities there. And year-end tax planning. Again, most business owners know bonus depreciation, Section 179. It's a great immediate cash savings on years that you have great income. My recommendation for any of these tax planning strategies is reach out to us, later in the year, in quarter 3, quarter 4. Let's talk about how your year's shaping up to be. Let's see if there's any decisions that we can make in October, November, December to help accelerate, decelerate income or expenses, and really strategize the best way to report construction income. And with that, we're going to go to polling question number 2. What types of topics would you most like to see on future McKonly and Asbury webinars? Technical accounting topics, tax and regulatory topics and strategies, technologies, or other? And please offer suggestions in the survey.
Thank you, Aaron. All great points. I love the point on the tax planning, because obviously this year probably more so than a couple years prior. There's definitely plenty of opportunity for planning, especially as we head into a new administration. We don't know what the taxes are going to look like over the next couple of years, so definitely some opportunities for planning, and probably some opportunities for credits that folks may not have realized were out there, and definitely want to take advantage of those, because it's like the R&D credit, dollar for dollar. The retention credit's a tremendous opportunity for businesses as well.
Yeah, my biggest, again, recommendation: let's be proactive. Start the conversation early. It makes it easier on us. Get you the right answer.
And there we go. A little bit of mix of technical accounting, tax, a little bit of mix all over the board. So yeah, we hope by the time this presentation's over, we have quite a mix of topics in this presentation, which was our goal. We wanted to make sure it wasn't all technical, but we wanted to make sure we provided those key technical updates. So if there's other technical topics out there that you'd like to hear us talk more about, if we don't already have it scheduled, by all means, reach out and give us that information. We appreciate it.
Yep. Thanks, Dan. I think, Dan, you're up next.
I am. Yeah, with that, we're gonna move off to technical topics for a few here. I'm going to talk about construction in a post-COVID environment, and then we'll head over to Gary, and he's going to give us some information from a surety perspective and looking at the industry as a whole. So obviously looking at this slide, pandemic top of the list, looking I can't even say post-COVID, but looking forward to hopefully we get to a point where we don't have to talk about COVID, but I would say pandemic, as the first bullet point here indicates, completely eye-opening. I can't even say just for construction. I'd say across the board, all industries, but I emphasize construction because I think it's especially early on, as we talked about, it's been impacted greatly. For a while, construction was completely shut down. Pennsylvania, some other areas shut down as well, but there was already a labor shortage. There was already labor concerns. I think we're seeing that continue. We're continuing to see labor costs continue to escalate, and that's across the board. I don't know if geography necessarily limits that. We're definitely seeing increases in labor costs. Now we're seeing increase in fuel. Costs of insurance are continuing to escalate. Since COVID hit, now workplaces are fragmented. So you have some people working remote. You have some people coming back in. You still have people in the field. Maybe some people in the field that were in the field prior to COVID, now they're trying to work remotely. Potential reductions in office space as businesses look for opportunities to move forward, maybe with a little bit less space. And then it's no secret job site safety measures have increased. I think all of the above have kind of heightened awareness for technology, both in the office and on the job site. So we have a wide mix of clients at McKonly and Asbury. We also have a wide mix, I believe, on this call, as I looked at the registration lists prior to the webinar. So I think we see technology all over the place, from early adopters to making sure they want the latest and greatest with all the technology, to some that might be a little bit slower, just like in any other industry. But I think through the pandemic, it's just increased. The thought process around technology and the need for investment, it's just there. It's COVID and the pandemic put it at the forefront of the discussion. So if companies weren't having those discussions, they're having them now, because whether you want to go full in and increase your investment in technology to a whole new level, or a little bit, they're definitely discussed and it's out there. With that being said, a couple of things that I want to mention with some things in the office that are probably things you hear about more often, especially from the business environment. ERP systems. If you have a good ERP system, it's going to allow a very smooth flow of data, both on the job and in the office. So there's plenty of opportunities out there with ERP systems. Sometimes you want to commingle a system. Maybe one size doesn't fit all in a system. I would also say there's probably be a tremendous push for eliminating the paper. So historically, contractors have a lot of paper floating around. As we shifted off-site to work remote, there's been a need to increase the electronic transfer of that paper, whether it be through email, scanning, but even beyond that, there's a lot of technology out there that allows you to basically digitize everything you can with your paper, so you're not worried about who's in the office, who's not in the office, who's at the job site. Everything's available to everyone. Document automation. I don't see a lot of this yet, but there's software out there such as Hot Docs, things like contracts. It takes away a simple Word file, so you're not just using words and worried about human error and things like that. It automates some of your contracts, so it's a little bit less risk for error. Something I'm seeing a whole lot more of lately is e-signatures, things like DocuSign. That's definitely a relevant technology, especially in today's environment where we have fragmented workforce. And then obviously we're all probably overly familiar with video conferencing at this point with Zoom and Teams, but it's here to stay. I think that software will continue to improve as we have people working all over the place. We also have technologies on the job site, and I would throw ERP systems in there as well, because with a good ERP system, the job site's connected to the office. So definitely something you want to evaluate. I'd throw in building information modeling, not a new topic, but I think more relevant, especially in today's day. Expanded use of drones. I've seen several clients using drones, but I expect that to increase, especially as camera technology increases, things like 360-degree hard hats. It allows people, less people on the job site, maybe some more work and inspections to be done remotely. One of the big things that I love is the fleet management, health, and telemetrics, or telematics, I'm sorry. And that's a tremendous opportunity. That technology is out there, whether you buy all new equipment or buy additions to your equipment to better track your equipment, the usage, the idle time. Where's the equipment? Something sitting idle that you can use on another job site, but that's all here. Technology is it's not something in a dream at this point. It's all here, and it's relevant. If we can flip to the next slide. These are just some examples on a quick search that I found of things these are completely autonomous vehicles. So I haven't really seen any of this in action at a client yet, but knowing it's here, just like Tesla and things like that, if you told me the next 10 years, I would expect to see some of this at least start entering some of our client spaces, whether it's a big or small contractor. I mean, this stuff's completely autonomous, whether it's laying bricks or painting, it's all here. One other thing I do want to just throw out there is blockchain technology. You've probably heard some of that. I think that's way off in the distant, maybe not way off, but definitely in the distant future for construction. And that's going to allow a whole nother level of tracking products through the system, down to, I think, one example, reading if you install the wrong pipe in a building or a structure that you're putting together, the blockchain and the pipe, there's enough technology to identify that before the building gets completed and avoid some potential errors. So the technology is coming. It's coming at a rapid pace, and there's a tremendous amount of opportunity in construction. So with that being said, I would emphasize with construction, if you don't already have a strategic plan, or maybe you haven't revisited it in some time, I would definitely develop a strategic plan for technology, and make sure it's including not just the software, but making sure you're aware of all the equipment that is out there that might help your business, especially as we look towards labor shortages in the future. Technology is going to play a key role in getting through that gap. I think as we look at that as well with people, just because technology is here doesn't mean you don't need the people. Where I see there's going to be some opportunities for people to move into other areas and create additional opportunities. And what that does, I mean, it's basically a technology disruption. But you're going to need people to interpret data, analytics, obviously with increase in technology, more cybersecurity. But I think it also offers a tremendous opportunity for training your existing employees to do all the things that machines can't do. So the customer relationships, building customer loyalty. You should be looking ahead of how can I have a lot of great people. Technology might be helping ease some burden on some of the jobs. Now what can I have these great people doing, and making sure they have adequate training to do that. The last point on this is making sure what your customers are looking ahead to. So there's things they're looking ahead to, and we want to make sure that we're understanding their needs so we can adapt our business as well. Next slide, as we talked about training, I just want to point out McKonly Asbury is a partner with Dale Carnegie, and we support a lot of construction companies in the market. A lot of opportunities for training as we talk about the disruption from technology. Definitely several areas on this slide that you can work with Dale Carnegie on to increase the people's knowledge, and make sure that they're ready for this disruption, and making sure you have things to attract better and more talent. And with that, I will get to polling question number 3, and then we will shift over to Gary. And this question is, what is your company's timeline for having employees return to the office in a substantial way? First, our employees have already returned in a substantial way. Next is we continue remote, no immediate plans for previous capacity. Second quarter, third quarter of 21, or fourth quarter of 21 or later. And I think for me, as I look at this question, I'm definitely seeing a mix. I think it's probably a little bit slow to return to capacity. If I had to say if there's any industry returning a little bit quicker, I probably would actually say it's construction. I have seen probably a few more people back in the office for our construction clients, and I think it's because so many people are out in the field and things still running through the office. I've definitely seen more people back in the office with construction companies. Yeah, and it looks like that's probably what I would expect, to continue remote. No immediate plans, it's working. I hear a lot of positive feedback on it. Doesn't work for everyone, but I'm hearing a lot of good feedback. So thanks for those responses. With that, I'm going to shift it over to Gary.
Thanks, Dan. Appreciate you and the team inviting me back for another year. I couldn't help but reflect. It was February of 2020 when we were socially distancing about 2 feet away from each other in the McKonly and Asbury, broadcasting room. And there was an inkling of something going on in China, and I don't know that we were could fully appreciate what was about to happen. And this was a slide from last year, and the one chuckle I get out of it is that first line: enjoying unprecedented extended economic cycle that started in June 2019 or 2009. That's probably the last time in recent memory that unprecedented was used in a positive way. We've certainly seen that word used quite a bit in 2020, but it wasn't in that context for sure. So, back at that time, before the pandemic really took hold, backlogs were healthy, margins were slowly rising, and most construction firms were profitable. And there was that fierce competition for skilled labor. And our forecast was, despite some of the distress and the economy wasn't going quite as strong as it had been, things still remained positive. It was growth, just slower growth, and interest rates remained low, and state revenues were up, which equated to public spending. Which the last boom really was driven by the private sector and money being spent there. So that was what we thought going into the before the pandemic hit. And who knew, right? On March 13th we had the emergency declared. We had widespread shutdowns, and depending on what state, a lot of construction was essential versus non-essential, but there was also supply chain disruption. I remember I have a client who's builds healthcare facilities, so that was essential, but he had jobs in various stages of completion, and he couldn't get door and hardware because the door manufacturer was not essential. And so it created a lot of complications and certainly new safety protocols. I think that the decline of the economic indicators in March and April were unprecedented and kind of fell off the table. And through last year, state coffers were depleted with the reduced tax base. So that kind of wiped out our anticipation for what might happen on the public spend side of our business. So the challenges are well documented. And I think one of the things, overall, coming out of 2020, Construction Risk Partners, we're a surety and insurance broker. We have and solely focused on the construction and real estate development space. We have about 200 clients. And by and large, everyone came through this pretty well. Now, some were more reliant on PPP loans, but one of the more challenging aspects of this, what I'd call pandemic-induced recession, was the uncertainty that was created. It was, back in 2008, 2009, that wasn't a financially induced. That was bad loans that drove a result and created a liquidity crisis. Here, there was no such thing. It was a health crisis that drove us into the shutdowns and the like. And it's a little bit harder to predict how the economy would rebound from that. Very difficult in terms of productivity with the starts and stops and the new protocols to enter job sites relative to safety. And we had contractors, trying to plan for building a backlog, and some of the projects would slide more so than normal or canceled. And so the big challenge became backlog replenishment in many eyes. Oops, sorry guys. Just to kind of highlight that, for those that aren't familiar with the Architectural Billings Index, it's an economic indicator used by the industry, and anything over 50 indicates growth, and anything under 50 represents shrinkage to varying degrees. And the picture is clear here, right? From February of 2020 to January of 2021, we did not pierce above the 50 kind of break-even line. I guess the good news is, right after I put the slide together, the February numbers came out, and the ABA is went from 44.9 to February of 53.3. I guess the one caveat I'd offer there, this particular slide, that's a national survey, and they break it down by region. And within the Northeast, which most of us are working in, that still has not pierced the 50 threshold. It was at 46.9 through February. A little bit better in South, for like in South would be Maryland and below. So just kind of an indication of why it's been so difficult relative to backlog. And here's the Associated Builders and Contractors Backlog Indicator Report, and this kind of highlights the same thing. You know, looking at it overall, February we're starting to see some optimism, right? So backlog, instead of seven and a half months back in January 2021, we've stepped up to over 8 months of backlog, and our region is the same. It's hovering in the 8.5 months of backlog. So there is some signs of optimism, which is a great thing. So from a backlog replenishment standpoint, you know, it's not one size fits all. There are certainly winners and there are losers. And this slide I thought did a good job of kind of highlighting that. Some of the losers are quite obvious, right? The commercial office space building is down, and it's the 3 to 6 month forecast continues to think it will be down. Entertainment and theme parks, hotel and hospitality, and retail and petroleum. And the petroleum was a little. I think that's down somewhat due to the pandemic and somewhat due to the new president and his economic or his legislative agenda relative to carbon and emissions and the like. So you know, some of the things we're starting to see. Because of the stimulus packages, it's looking like education, K through 12, might be a winner moving forward. Distribution and warehouse has absolutely been strong. It's been strong before the pandemic. I think the pandemic just solidified the fact that, you know, our economy is moving to an e-economy, and so, you know, having that kind of you know, that just-in-time type warehouse distribution centers are going to be absolutely critical. So here's our last polling question for everyone. How does your company current project backlog compare to your backlog as of March 2020 versus current year backlog exceeds prior year, current year backlog is less than prior year, current year backlog is similar to prior year, or the worst answer of all, unsure? In this I do think it really depends on what market sector you're in. You know, if you were primarily doing retail work, I would think that your backlog is down. We've certainly seen it in our clients. Whereas, you know, we're still seeing we have some clients very focused in the multifamily space, and although it's not as hot as it was, it's still pretty robust. And it's kind of transitioning to low income housing from more market rate apartment type stuff. So it's like I said, it depends on what area of the country you're in also.
Yeah, and I know I've talked to a couple clients. They have obviously they have the people have come back, they have workers, they have the ability to do the work, and the competitive process with the bids that come out is tremendous. And so experiencing fee pressures and things like that is definitely impacted their backlogs.
Yep, and so this is across the board, and I think just to stick it to me, 33% of you are unsure where your backlog is. So hopefully that's not the CFOs on the phone. This is another index survey from ABC, and it tells the picture of confidence, and I like this because it breaks it down. And I'm a little bit more focused on the profit margin expectation, which there's a slight move towards thinking things might get a little bit better, which is good to see. I guess from what I see in the concerns that we have, you know, there is less work available, and the bid list that we see certainly in the public side have increased. And so inevitably in this cycle, you know, with heightened competition, a number of things happen, right? And primarily it's margin deterioration, because in order to get the job, if you're bidding against 20 other bidders, you really have to sharpen your pencil. So that's that's a concern. I guess the other thing, and I'm kind of a junkie in terms of the economics, and over the course of the last few months, most economists think that our economy will really blossom come the third quarter, fourth quarter of this year. In a very, and most of them think in a very meaningful way, which we'll cover a little bit later, but will be interesting. So we do think there's going to be increased risk, despite the optimism moving forward in terms of the third, fourth quarter. And I think it's really important to go into this with your eyes wide open and have a plan. And this never goes out of style in terms of have a really disciplined go, no-go process in terms of what market sectors you're in, what geographies you work in, how to manage a greater competition, and also in terms of a contract review. I think we see a lot of issues created by signing bad contracts. And so to have a disciplined go, no-go process in terms of what you'll accept and what you won't accept is absolutely critical. And it's really, premier contractors are absolutely astute at analyzing, managing, and pricing risk. And if they can't do it, they don't bid it, or they don't sign a contract. So what trends are we seeing relative to the surety marketplace? The nine month numbers are showing loss ratios that are up 22% compared to 16%. And that equates to a $1.2 billion in losses through 9 months of last year. Now it's hard to kind of separate that. I do know through some of our relationships with the senior management of various surety companies, some of that 1.2 billion is reserves for anticipated losses that might come due to the COVID outbreak. So they may come, they may not. But the surety claims severity is continuing to rise. Surety, I'm sorry, this is last thing. I'm running out of time here. The recent data, this is an important fact. 50% of contractor defaults are caused by one catastrophic project in backlog. So once again, going back to that go, no-go process. I think we're probably going to run out of time. This slide just gives you an idea of where the losses have gone. And it really, we wonder if the economy does increase third, fourth quarter, are we going to enter another loss cycle, which is what that black line here indicates. And we've got our eye on that, and sureties are concerned about that, and you're going to feel that in a hardening surety market. So despite the storm clouds, fiscal year in 2020 was the 15th consecutive year of profitability for the industry. But like I said, there are storm clouds on the rise, and the loss ratios continue to rise, and there's signs that the surety reinsurance market, which supports the surety, is also tightening. And it's going to manifest itself in terms of tightening underwriting, not for quality contractors, but those contractors that may be on the edge or are slightly undercapitalized. So the warning signs are out there, and you probably need to plan accordingly. So quickly, issues. Surety is a lagging indicator, so some of this stuff we won't see manifest itself in surety results in 12 to 18 months. But the sureties are back to basic. They want to understand your business plan. They want to understand management's philosophy and their experience, and the adequacy of your financial position relative to your volume and backlog. They want to understand that backlog and the profit margin embedded in it and the risks embedded in it. And we're starting to see material price escalations. Year over year, they're up 7%. Steel, natural gas are leading the way. And how do you manage that price escalation relative to your projects, your subcontractors, and your contractual risk? Confirmation of finance, we've seen a number of projects on a private side go bad because financing was pulled, and the contractor did not have an opportunity to pull out and was left holding kind of an empty bag. And lastly, there are a lot of questions and focus on PPP loans and when they're going to be forgiven and if they're forgiven. So once again, best traits: be discerning, be thoughtful. I'm not going to read through this since we're right up against it and I'm mindful of everyone's time. emphasize discipline, go, no go process, and talk to your surety partner and make sure they understand that. That will go a long way. In this environment, more communication is way better than less. It's not as, virtual is not as good as face-to-face, but, with our clients, we're certainly getting together more than once a year just to make sure that the surety is on board with the contractor's plans. And for those of you, we do a quarterly surety update. For those of you that are interested, we kind of break this down in a concise manner. Just reach out and we'll be happy to put you on our mailing list.
Gary, thanks for that. And thanks for getting us to 3 o'clock. I appreciate it. A lot of good information. So yeah, the slides are out there. I appreciate that. Appreciate you sharing all that with us. Yeah, it is crazy a year ago, a little bit before a year ago today. I don't even know if we talked about COVID on the webinar. So glad you brought those slides up. Thank you. To everyone else, thank you for joining us for today's webinar. If you have any further questions regarding today's presentation, please feel free to reach out to one of us and we'd be happy to assist. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who requested CPE and answered the polling questions, those certificates will be sent out within the next 2 weeks. Thanks again for joining us and enjoy the rest of your day.